so much for joining us again with the podcast Meet Up with MeLa. I am your host, Melissa Lauren, and that's where I get the name MeLa, M-E-L-A. I'm here today to do a financial podcast with one of my longtime friends and someone I admire greatly in the financial world. I think she'll have a lot of great information for you. I want to welcome her. This is Christina Gatteri. Hi, Christina. How are you today?
Hey, Melissa. I'm doing great. How are you?
Good. Thank you so much for coming on here. I'm so excited to have you, and especially as sort of an additional podcast in terms of our new year kickoff of 2021. And I think a lot of people want to know just some things that we should be looking for and what to anticipate. And I think you'll be a great help. I do want to first start. The reason that we're doing this podcast is because I think finances can be something that are definitely intimidating to people. It's hard to talk about, especially when you might not have a lot of guidance, information, direction. So I really welcome you today, and I just want you to be completely honest with us and really just answer the questions that I think are coming up now with COVID, but also just in general with 2021. So thank you again so much it's great to even have you here. So what I would like to start out doing is obviously just introducing you. So basically, the way I know Christina, which is great, is we went to high school together. I'm not going to say what year we graduated, but it wasn't that long ago, right?
No.
So yeah, no, definitely. So we went to high school together, and I've seen Christina, her career develop over the years, and has been on certain things like even the local news, and has done different things in terms of her own Facebook and podcast. So I think that's actually really cool. And I know that she's someone that can be trusted to have some of these important conversations. So I definitely want to welcome you today. And again, thank you so much for being here.
Yeah, I'm excited to have this conversation. Thanks for having me.
Thank you. So the biggest thing is, what brought you to working in the financial industry? What do you find challenging and most rewarding about it at this time?
Yeah, so what got me to working in the financial industry was, funny story, when I started college, I was a marine biology major. And It turned out that I just wasn't wired to remember all the Latin terms of biology. So it just didn't work well for me. So I decided to take a couple of economics classes just to see and feel out where I should go next. And I absolutely loved it. What I loved about economics, which is so applicable to financial planning, is that you can be presented with one problem and there is a dozen solutions. You just need to test each one, see which one is going to have the result that you are most looking for. So it's either some trial and error or some educated guessing, trying to get where you're going.
Okay.
And what I love about financial planning, I've been a financial planner specifically for 13 years. And when I introduce myself as a financial planner, people often stop at the thought of, I help manage investment portfolios. She's managing stocks. How's the economy doing? Those are things that I get asked all the time. People don't realize how much of their life and their feelings and their well-being is involved in their financial decision making. So I really love to tap into people's stress levels, their routines, their lifestyles, and helping them understand how to make really great mindful decisions.
That's awesome. And so what would you say is the most fulfilling part of your job?
Oh boy. I love getting those follow-up emails that say, you know what, Christina, I heard what you said. Thank you for listening. I tried this and here's what happened.
Okay.
Getting that follow-up to the example that comes to mind all the time is people will come to me with these financial problems, not realizing that there's a lot of emotional things underneath that also need to be addressed. And the example I like to share when describing this is there was a young lady that came to see me who I'd known for several years. She had racked up a lot of credit card debt. So what prompted her to call me was to ask for advice to how to tackle it, how to get it back under control. But come to find out, she had lost her father. She ended an 11-year relationship. She was living on her own, which is where the credit card debt came from. And she was feeling guilty and overwhelmed by all of it. So
Yes.
When we were able to talk through that and give her some steps to not only start to fix the financial situation, but also help her address those stress and related things and those life changes, the email that she sent me just telling me about all the developments that she made, there's nothing better than that.
No, that's amazing. And it definitely, I think you're definitely invested in that. And sounds like you're also a lifetime learner, similar to myself.
Mhm.
And so, did you feel like working with people that sort of, working with people and seeing some of these things, did that help you in terms of even deciding to continue your education in some ways? And do you mind sharing some of that?
Definitely, definitely. So I realized in my 13 years as a financial planner, although this was a couple of years ago, I started on this path, was that I had better relationships and deeper relationships with my clients if I was helping them with more than just the balances on their statements at the end of the month.
That's
And so
amazing.
yeah, and I also realized of the two segments of my business with sort of the planning and the decision making and the creating steps for people, and then the portfolio management, which is another important piece of it. I definitely enjoy having the conversations about lifestyle and routines so much more than I enjoy the portfolio management. It's very left brain, very analytical, and I get
Mhm.
tired of it after a while, right?
Okay.
So that's when I made the decision to go back to school and get a master's degree in mental health counseling, because I find that there is already such a huge component of mental health to the financial decisions that people are making.
Mm.
And I wanted to be able to offer more. So, yes, it was a little over a year ago now that I started a program for clinical mental health counseling, and I'm wrapping that up hopefully by the end of this year.
That's amazing. And I think that it's so much we see, like so much is tied together like that, like you said. And I think sometimes it's about paving your own path and realizing too that it's like, financial counseling, something that does seem so analytical in so many ways. And then as people are letting you into their lives, you realize there are so many other components and you're helping people in many ways. So I definitely applaud that and definitely encourage it. And I think that's amazing. So
Thank you.
thank you for sharing that. I think
Sure.
that's huge. So in terms of like starting out, I think in terms of 2021, where we're coming off of a tough year. 2020 had been a tough year for many reasons, and I think for a lot of people it's very painful. I mean, uh,
Hmm.
I know a lot of Americans were waiting for stimulus. There's a lot of people that have food insecurities, housing issues, trying to figure out how to pay bills. So I definitely want this to be a podcast that reaches a lot of people that the biggest question isn't that they have $1 million and they're wondering how to invest it. I think most people are really trying to figure out and make some really tough decisions. So those are some of the questions that I want to ask you today, and hopefully that we can get to the heart of the issues. But I feel like it's also questions and hopefully some topics that everyone feels comfortable. Maybe comfortable now talking about, or maybe getting a little bit more information, and hopefully leads us to a better place of maybe financially being better to ourselves, because I think
Yes.
sometimes when you don't know, you don't know. So definitely. So as far as for Happy New Year, obviously 2021. Can you tell me what are we looking at for 2021? Are we thinking it's going to be much different from 2020? Is there some hope on the horizon with a change of government and administration? What are your thoughts on that?
I have a suspicion that 2021 may look very similar to 2020. I do think we've got some advantages with the new administration. We're probably going to see more aggressive stimulus packages come out.
Okay.
But I say it's probably going to look similar to 2020 because the only time we're going to get to a point where we start to see significant change and real turnaround or real return to whatever normal might look like in the future is when the virus is under control.
Okay.
So we are dealing right now with a slow rollout of the vaccine, but it's rolling out. So that's promising. That's a big change from 2020. But now we're also dealing with a new variant, and now we have to test to make sure the vaccine is still going to be helpful, which we believe it is. So there's so many factors working together, but the expectation I'd set is I'd keep the bar where it is for expectations for 21 and hope that our government can put some bickering aside and really take action to help Americans that need it, because they've got a lot of great ideas. They've implemented some good programs. We still have some hurdles in making sure everybody knows how to access those programs.
Okay.
So stick with it, ask questions, and don't hesitate to fight for what's available to you.
Okay.
I see very often, just I'll use unemployment as an example. Some people may be denied for unemployment, especially for the gig economy workers or self-employed who generally aren't eligible for unemployment. If they're getting denied, You need to appeal. You need to ask the questions about why so you can understand, because in this environment, you need to be able to fight for what is available to you.
No, thank you for sharing that. And have you heard anything in terms of unemployment? Like, I don't know, is there a max in terms of number of weeks at this point? It's, especially because I do know there has been, like you mentioned, certain things that have come up because of COVID, especially people that are
Mhm.
self-employed and weren't eligible before, but now are. Are there maxes? Are there extensions that you're aware of? Anything to that extent?
Yeah, I know they did extend the additional payment for unemployment. Rather than being an extra 600 a week, they're offering an extra $300 a week. What I don't remember off the top of my head is how long that's lasting.
Okay.
If I had to guess, it's probably only going to be a few months. It's probably only going to last maybe through March. Like I said, I'm kind of guessing at that, so don't quote
Okay.
me on it. But from this latest stimulus package, it was a stopgap. This latest
Okay.
package was a stopgap so that not everything completely ran out. We need something to continue until the next administration takes over and can work more aggressively for a more robust package.
Exactly. And I think the thing about it too is it's like when we think about the package, if people are behind on mortgages, rents, and other major things, $600 for people, for one individual person, sometimes, I mean, that's really sometimes a drop in the bucket. It really doesn't contribute a lot to some of these really serious needs. And unfortunately, there's a population too of 17 through 24-year-olds that actually are not considered part of the stimulus if they're claimed as adult dependents.
Mm-hmm.
So there's, which is mainly our college population, our young adults that, really could probably, use that as well. So definitely we're hoping that hopefully in the year ahead,
Mm-hmm.
very soon after the administration takes over, that we're seeing that there is some more hefty stimulus packages to come, especially to, just pay some very basic bills for some people.
Absolutely.
With that being said, let me ask you, for COVID related, so some of the next topics I'm going to talk about are specific to COVID and some of the new things that we've seen, because it has been such an issue with people financially. So many institutions, I know, including credit card companies, mortgage companies, student loan lenders, are offering assistance or payment options during COVID. So how does this affect your credit score if you take advantage of any of these payment options? I know even like when I go to pay my credit card, or even when I go like online to pay, it's like, hey, are you having any problems based on COVID right now? And it's like, wait a minute, what does this mean exactly? So I definitely wanted to ask you about that because I think that that's something that fortunately, I'm very fortunate in the sense that I've been able to stay employed throughout this time of COVID. But I know that that's not everyone's reality. And I know some people that are even they were able to stay employed, it might not be at the level that they were at before in terms of earnings and being able to
Right.
pay things. So anything you could offer us about any kind of COVID relief or different options would be very
Yes.
helpful.
Absolutely. The two popular terms that we are hearing as far as assistance for payments on debt are deferments and forbearance. And unfortunately, the terms have a tendency to be used interchangeably, but there are some decent differences between the two. For example, if you are granted a deferment, and this could be it's most popular with student loans, but you could also have a deferment of mortgage. You could also have a deferment of credit card payments. What that means is interest will stop for the time that you are allowed to defer, and that length of time is determined on a case-by-case basis.
Okay.
So the interest will stop accruing, which is nice, but even though you don't have to make a payment, and this is especially true on mortgages, one of the fine print pieces that you need to pay attention to is that they're allowing you to not make a payment, which means they won't start a foreclosure process, okay? Or they won't send you to collections in the case of a credit card or a student loan. But
Okay.
it doesn't mean they can't report a late payment to your credit bureau,
Okay.
because technically you are not abiding by the repayment terms of the contract.
Okay.
So they may not take action to go after you for the lump sum. They'll give you that breathing room. But if you take advantage of a deferment or a forbearance, I would say expect to see a negative impact on your credit for the months that you are not making those payments.
And do you mind explaining again? So deferment is what?
Yes. So deferment is going to stop the accrual of interest. A forbearance means you're going to still have to pay interest. Deferment means you can just skip a couple of months and then pick up where you left off when it starts again.
Okay.
Forbearance is you're going to skip a couple of months, but the months that you missed, that balance is going to be tacked on at the end. A mortgage is a great example of this. If I take a 6-month forbearance on my mortgage, then those 6 months worth of payments are tacked on to the end of my loan, which means on the maturity date, on the original maturity date of my mortgage, I will now have a lump sum payment that I have to come up with to make up for those months that I didn't pay.
Okay.
Yeah.
No, thank you so much. I think that definitely helps, because again, sometimes it seems like, yeah, I want to take advantage of this. This is great. They're understanding that I have been affected by some of the terms of COVID, but what does that exactly mean? And later on, you don't want to be surprised. That's for sure. You might feel some immediate relief, but you certainly don't want to be shocked later on. So I think it's very helpful.
Let me add this to it also. There are lots of people I've spoken with that took advantage of a mortgage forbearance out of convenience, just so they could have a couple of months of relief, but it wasn't an urgent need. And then there are folks that are taking advantage of it to avoid foreclosure. So if you're going to choose to take the hit to your credit, then use it as a tool to stave off foreclosure. If you are in absolute urgency and you are worried that if you don't make your payment, the foreclosure proceedings are going to start, then a forbearance is a good tool for you. I would hesitate recommending anybody take on a forbearance if they're just looking for a little bit of relief, because there can be long-term credit impacts.
Thank you. And so when you also say that, it brings up a good topic in terms of possible foreclosures on homes and also evictions. I know that I've heard that there was some moratoriums in terms of evictions that were put in place because of COVID. I'm not exactly sure of the status of that right now in the state. But is there, number one, can you talk a little bit about that? So like eviction and foreclosures, thinking about these things, how would this obviously overall affect your credit overall, and for how long? And especially where most people, if you're getting foreclosed or you're potentially getting evicted, you need another place to live. Most people the reason why we're paying for a place to live is because we need a place to live. So what are some of the options there, and what are your thoughts on that?
Yeah, definitely. So first, I'll start by addressing the credit impacts. There really is a magic number when it comes to your credit report, and it's 7 years. Any derogatory remarks will fall off after 7 years. So that goes for forbearance, deferment, just a missed payment on a credit card, a bankruptcy, all of those things. You got to give it 7 years to fall off. What's nice about the 7-year timetable, though, is that as time goes on, as each day and as each month passes, the impacts of that negative remark lessens. So it's sort of something that wears off with time. So by the time you get to that 7-year mark, the impact is pretty minimal. Okay. As far as evictions go, I said earlier in the call that the latest stimulus package is kind of a stopgap until a bigger, better package can be instituted. And evictions is a really great example of that. Originally, people were protected from eviction until December 31st, 2020. This new package has only extended it until February 1st of 2021. So really, there's only about a 1-month breathing room until landlords can go back and seek evictions again. So unless something changes or until something changes, that's the plan right now. As far as mortgages go, the only program that's offering foreclosure moratorium is if your mortgage is backed by FHA, which is a pretty popular mortgage product. So if you're not sure if your mortgage is backed by FHA, give your lender a call and they can tell you. They are not sending anybody to foreclosure until after February 28th.
Okay, great to know. And with that, I mean, are there any other programs that someone can reach out for in terms of, I guess the most important thing might be just to try to communicate with, say your landlord or your management company that might be managing your apartment lease or something to that extent, or even the lender. I mean, is there any other programs that you know of that can help with any kind of, relief specifically surrounding housing?
Definitely, yeah. So the latest stimulus package did introduce another $25 billion for rental assistance. And something that we ran into with the original stimulus package is it was really difficult for people to figure out how to access this. So what I'd like everyone to do if they're in this situation is reach out to United Way. You can call 211 and get the United Way to help you with those housing questions. They have a specific team dedicated just to these housing assistance related issues. So keep 211 in your back pocket. and they will be able to direct you to the proper agency to take advantage of the rental assistance.
And Christina, can I just ask you, so, when we hear of like evictions, is that something that if you're evicted and say like you haven't paid for the last couple months or whatever, or you're thinking, oh my gosh, I am going to be evicted, I haven't been able to pay, is it something that say by the time you would still need, there would still need to be obviously a court hearing, I would assume, in terms of evictions. Is that something that you feel like, I don't know if you even know this, if landlords, or if there's any opportunity to sort of work out a payment plan at that point, or should you be trying to pay as you can? Like, what do you sort of recommend, or what do you think might be the best option to maybe even potentially, not make eviction the inevitable, I guess?
Right. It really depends on the landlord. There
Okay.
are some landlords that have been very accommodating in allowing people to make lesser payments, knowing that there's such a huge economic impact in our country right now, and some are not. The
Okay.
best thing you can do is just keep an open line of communication. Is as difficult and uncomfortable as it is. You don't want to hide from your landlord. You got to stay in touch,
Okay.
and if they do allow you to set up a payment plan, at least it'll keep you in your home.
Okay.
If they just happen to be hard-nosed about it and they are ready to put you out, like I said, get in touch with United Way at 211, get some rental assistance. The one piece of advice I'd say is don't send a partial payment without a prior arrangement with your landlord. And the reason I say that is because if they're going to evict you anyway, then
Okay.
don't throw good money after bad. If you can't pay the full rent, and even taking partial rent, they won't accept it and they plan to evict you, keep your money.
Oh, okay. And so for an eviction or a mortgage, can that follow you around, like say after an eviction or foreclosure? Like, can they ask for the money? Are you still financially responsible for that money and paying that back?
If you had a written lease, that's
Yeah.
your contract saying that you're going to pay. So yes, they could still attempt to pursue collecting that debt, which would
Okay.
put an account into collections. Collections accounts have a tendency to stick around sometimes a little longer than the 7 years, especially if they end up, I don't know if anyone's ever had this experience of a collection that bounces from collection agency to collection agency because they're just buying up each other's debt, all in an attempt to collect it. So because it constantly changes hands,
Oh,
sometimes that lengthens that 7 year process because every new company that takes over now, it's a fresh 7 year clock.
okay.
So that can get challenging.
Okay. No, definitely. And would an eviction, I know a foreclosure, again, could go on your credit. Could an eviction go on your credit? Like, can a personal landlord like have a way to potentially affect your credit?
I'm not certain about that. There have been instances where I've seen judgments on people's credit reports. Usually it's for things like tax liens. I think
Okay.
you're more likely to see the money that was owed to the landlord with a collection agency on your credit report, as opposed to something that specifically lists an eviction.
Okay. No, thank you. I think that's very important. And, again, I think a lot of people are unfortunately in some really tough situations and having to make some tough decisions. And we're hopeful that that will end. But at the same time, for some people, it can be, obviously, there comes the emotional aspect of it, right?
Yes.
I mean, it can be very emotional and very unsettling. And I really appreciate this information. I also know that in terms of that sort of leads me to, again, people having problems potentially with just trying to meet their bills, and obviously keeping a roof over their head and that kind of thing. What would you say in terms of people potentially even having to borrow against a 401k or a
Mhm.
403b or something to that? Is that a better option potentially, or is that a better option? Obviously, if it's about keeping a roof over your head, that's obviously the ultimate
Yes.
goal. But are there any provisions in place right now in terms of COVID that makes borrowing against maybe a 401k or 403b any easier right now, or less penalties associated?
Sure. So I'll start by addressing your question about borrowing. Borrowing and withdrawing from retirement accounts involve two very different sets of repercussions.
Okay.
If you can borrow from your retirement account, that is the best case scenario.
Okay.
And 401ks do let you borrow against them. You're allowed to borrow up to half of what you have in the account. up to a maximum of $50,000. And generally what happens is, yes, you do have to pay that loan back with interest, but what happens in these 401k loan programs is you pay a small fee to set it up. Usually it's a $50 fee. It's very nominal. And the interest that you pay, let's say it's a 3% interest rate. 1% of that interest goes to the lending company for their overhead, but the remaining 2% interest you actually pay back to yourself. It goes back into your own 401k. So it's a nice way to be able to borrow money that you've saved that does not have any income tax ramifications. It doesn't have any early withdrawal penalties, and you are going to pay it back to yourself. They pull it straight from your payroll. You set up a 5-year payment plan and it comes right out of payroll. So you do eventually pay that money back to yourself, replacing what you took for retirement.
Okay, great.
403Bs are very similar to that, where you can borrow against them.
Yes.
However, there is a little bit more of a hurdle to overcome with 403Bs. Now, 401k you'll traditionally find in a lot of public companies or in the private sector, publicly traded companies. What you find in government or municipal work or school teachers, police, firefighters, areas like that, you'll end up with a 403B program. It functions the same way. You're saving money for retirement.
Okay.
But when it comes to taking or to borrowing against or taking withdrawals, you actually do have to prove a hardship. There has to be a reason that you're taking the withdrawal, and the administrators have to approve your reason. Now, in the world of COVID, COVID pandemic related reasons have generally been approved. So if you do need to borrow against your 403B, you are likely to be approved if you are being impacted by the pandemic. But just know that there is that extra approval process when it comes to a 403B.
Okay.
If you'd rather just take the withdrawal rather than going through the process of borrowing and paying back, there's 2 things that are going to happen. You are going to pay, if you're younger than 59 and a half, you're going to pay a 10% early withdrawal penalty, and you're going to have to pay income taxes on the money that you withdraw. So let's just assume that you are in a 15% marginal tax bracket.
Okay.
So if you want to take a withdrawal of $10,000, you're going to pay a 10% penalty plus 15% income taxes. That means the government's going to keep $2,500 of that $10,000 withdrawal.
Whoa. Okay.
So it's an expensive way to borrow money.
Mm-hmm. But it is an option, at least in an emergency.
Yes, absolutely. And when it hits the fan and you need somewhere to turn, you have it available.
Okay. And would you say, like, so during this time, so say if you were to borrow or anything like that and you're doing a repayment, can you still contribute to your 401k during that time?
Mm-hmm.
Because that could be something where it's like, are you then stopping any of your personal contributions? Because again, we know that there are some companies that are great in terms of matching. So
Yes.
if you're still able to put some in, is that potentially an option if you're in a repayment?
It depends on the program. 401ks and 403bs generally, yes. I have some clients that work for, that are in the military, work for the Department of Defense, and their program, and I forget the exact acronym, but the government program, if you take a loan, they do not allow you to contribute until your loan is paid back.
Okay.
Mm-hmm.
So it really does depend, like, case by case. And
Yeah.
those are questions that you could certainly ask whoever is holding your 401k or 403b.
Absolutely.
Those with the options that you potentially have.
Yep.
Okay. That's definitely great. And the other thing that I think, people sometimes think about, and especially I've heard in terms of, some people that are homeowners and potentially maybe have lived in their home for quite some time, is the potential of needing some extra income. And I've seen this, like, even commercials or ads associated on reverse mortgages.
Mm-hmm.
So I think that, I don't know tons about a reverse mortgage, so I'd love to hear about it from you. And basically, especially people that might be retired or that, or feel like they're, maybe nearing the end of their career or maybe just working part-time. It seems like it's geared to an older population. What would you say as far as that goes in terms of reverse mortgages, especially in the context of maybe someone struggling a little bit economically?
Definitely. A reverse mortgage can be helpful in a pretty narrow set of circumstances. So it is geared to an older population.
Okay.
The first criteria to be approved for a reverse mortgage, actually, before I get to that, a reverse mortgage, what it does is it uses the equity in your home to send you monthly payments. Okay. So rather than going through the process of taking on a home equity loan or taking out a new mortgage or taking on a line of credit, something like that, the reverse mortgage creates a steady stream of income. The first criteria is that you do have to own your home outright. You cannot have any other mortgages or liens against it.
Okay.
The second big hurdle is that if you leave your home for any reason, if you pass away, if you want to sell the home, or for the cases of an older population, if for any reason you end up in assisted living or a nursing home for an extended period of time where you're not expected to return to the home, the reverse mortgage company will call the note. You will have to pay it back right away, which means it will force the sale of your home. So in my opinion, the narrow set of circumstances where a reverse mortgage could be helpful is if you are an older person who completely owns their home, and maybe you do not have any intention to leave it to heirs.
Okay.
Or you don't have any heirs to leave it to. So yes, generate some income for yourself. And then when you pass away, whoever is responsible for settling your estate can make sure the house is sold, pay back the mortgage, and whatever is left can be dispersed to survivors.
Okay. And so basically, because it is acting as income, it's counting as income, I would assume as well. So you're actually having to claim that as income, correct?
That's a good question. I'm actually not sure about that.
Okay. Yeah,
I'm tempted to say no, because technically it's tapping into the equity of your home.
Okay.
But I'd have to look at that. That's a good question.
And then, like you said, if you're no longer in your home as as that's your residence, and you have to go into, say, I would assume like something more long-term, like a nursing home, you probably don't get that income anymore. Like you have to be physically living in the home.
Correct.
Even okay.
Yes.
So. Okay.
And there's, because you've got my mind going down a little bit of a rabbit hole right now, but just a short point, that can be impactful for anyone who has applied for Medicaid to help pay for a nursing home stay. Because if you had a reverse mortgage and then you end up in a nursing home and you have no other assets, so you apply for Medicaid assistance to help pay for that nursing home.
Yes.
If you're forced to sell your home, now you are going to have a lump sum of money available to you that will be forced to be used to pay for the nursing home before Medicaid approves you.
That's definitely something I'm sort of thinking about, because again, we know like when there's something more long-term, like a nursing home, a lot of times, assets are definitely a concern as far as what you're eligible for. But no, thank you so much. I definitely appreciate you covering some of these things, because I think, again, it's some kind of, it might be some areas that people are sort of thinking about some of their options right now, even if they're not necessarily affected by COVID, but just some really important topics that I think make sense in terms of, what people are going through financially. So in terms of lightening the mood a little bit, I have a couple quick financial questions for you. So I'm going to ask you 3 financial trivia questions, and let's see how well you do. And I'm
okay. Here we go. I'm ready.
Okay. What is the most counterfeited denomination of money in the United States?
I'm going to guess the $20 bill.
Ding, ding, ding. You got it right. Woohoo.
Wow.
Definitely exciting. Yes, it is the $20 bill.
Yep.
And what would you say would probably be second to that?
Oh, probably the 50.
The $100.
The 100, yeah.
Next one. But yes, you got that one right. Yeah. So definitely kudos to you. I figured, I'm like, this will be a way we're going to test her out. Thank you. And then, so let me ask you another one here. I'm looking down here because I have a few different things. So, what would the typical lifespan be of a $1 bill? So from the time that it gets printed out by from the Federal Reserve and is on its way and makes it around the United States, what would be the average lifespan before it has to be retired and recycled and sent off?
Okay, so I'm going to go with my gut on this one because now I'm overthinking it. I'm going to say 40 years.
18 months.
Oh, my gosh. People are using that much cash, huh? Yeah. I guess it's not as durable as the penny.
I was going to say, honestly, it's like maybe that actually has gone down a little bit now, especially because everything is so we're dealing much more with plastic than ever before, and then obviously just wiring and everything's so digital. The other thing is, true or false, this will be one, and maybe I'll give you some more as time goes. True or false? More monopoly money is printed in any given year than money in the entire world.
True.
It is true.
Yeah.
There's more monopoly money printed every year than the money in the entire world.
I'm so curious to know if these questions were formulated before or after 2020, because we've played a ton of board games in 2020.
Oh, really? Okay, yeah, that is actually a really good point. I know board games are like going off the shelf. Actually, this was last updated August 26th of 2020.
Yeah, there you go. Oh, that's cool.
So it is interesting. So yes, definitely Monopoly money is flying off the shelves. So definitely, thanks so much. You were great at this. So definitely, it definitely proves just everything in terms of a financial planner, and definitely so I want to continue with some of the topics of conversation. So basically one of the other things that I wanted to ask you is if you're able to save during these times, is there a preferred investment option that should be considered? So like CDs, put more into your retirement fund? Should you be putting more into a savings? Where do you get more bang for your buck right now? And especially when it comes to potentially getting, potentially even adding to your money with some good interest rates.
Yeah. So getting bang for your buck is a loaded question these days. So let me start there, and then I'll talk about where you should be saving.
Okay, great.
So right now, interest rates are so very low. Anybody with a mortgage knows that interest rates are very, very low right now.
Okay.
But that also translates to, even though it's cheap to borrow money, it also means it's cheap to save money. Banks are not paying a lot of interest on your savings accounts at your local credit union or local bank.
Okay.
So when people cannot earn a good return on cash, that's when we generally turn to investment vehicles. The problem, which is sort of a good problem and a bad problem to have right now, is that our stock markets are trading at historical all-time highs. Excuse me. In an environment where we know our economy is challenged, unemployment, albeit better than it was at the beginning of the pandemic, is still worse than it was during the Great Recession of 2008.
Wow. Okay.
We are in a position where it would really have to be on a case-by-case basis that I recommend whether or not somebody take new money and invest it in the stock market right now. Okay. Because it's very, very high. And it goes against that old adage, right? The adage buy low, sell high has a lot of meaning to it. Right now, if you buy, you're buying high, and you're going to have to be comfortable with riding the wave. The other thing that makes me a little nervous about the precariousness of our stock market is the fact that we're ripe for a recession. We know that the average growth in our economy is like 10 to 12 years, maybe a few years longer, depending on the cycle. Our economy is cyclical. We boom and we bust, which is an extreme way to say it, but we grow and we recess. We grow and we recess. We're on the cusp of that. Our last recession, again, was in 2008. So we're now 12 plus years out from that. We're due for a recession. Our economy is really struggling, but our stock markets are at all-time highs. So there's a lot of conversation to be had around that individually with a financial planner.
Okay.
As far as where to save your money, I kind of like to list this in order of priority. Step one, you have to have emergency cash reserve. Don't even start considering investing money until you have 3 to 6 months worth of cash that you can put your hands on. I like to call it ATM accessible cash. Okay. 3 to 6 months worth, and you can break that up. You can have 3 months worth just in your regular savings account and another 3 months worth maybe in a CD. Again, CDs at the bank aren't paying spectacular amounts, but it's a little bit better than the savings account, so you can eke out a little bit from that. Once you've got your emergency cash reserve at a comfortable level, then you want to start considering putting money into your own IRAs. And there's a whole conversation that can be had around the difference between traditional and Roth IRAs. Another conversation that could be had if you're self-employed, there's additional options. So there's a great area to explore there. With all of that being done, you definitely need to consider putting money into your retirement accounts. If you work for an employer that has a 401k or a 403b or a simple IRA is another example of a retirement plan that could be offered by your employer. If they are offering you a match, at least take advantage of the match. If they're going to match 3%, then put in 3%.
Okay.
So 3%, if you're making $1,000 a week, You're talking about $30 a week.
Okay.
So take advantage of it, because the free match that you're getting from your employer is just that. It's free money. They're doubling your contribution just by you putting that little bit in.
Mm-hmm.
So get your emergency cash reserve in order. Let's talk about some IRA options, but all the while, please be contributing to those retirement accounts.
Okay. Thank you so much. That's like huge. And I think, again, when you break it down like that, it helps you focus, because there's so much that sometimes is getting thrown at us and you just don't know where to go with it. And unfortunately, there's so I think that's definitely huge as far as just being able to prioritize that. So I think that's definitely very helpful information, and I think it will make me number one, come to see you. Number two, really do a close look at where I'm at with things, especially. And I do have to say, I think, in all honesty, I think, we all come from very different backgrounds. And, again, I think, and all have very different needs as far as in goals and, what we're trying to accomplish, right here and now. So I think, a lot of times too, it's like, this might be the first time that some people are even hearing about some of these things. And it can be very, intimidating, and especially as you get older and you're feeling like, oh my God, I should know this, but it can be really scary to have some of these conversations. So definitely want to take some of the stigma and the mystification out of it, because these are conversations we all need to have at some point. And I certainly appreciate you being able to help us with this. These
are all the things that we say. Nobody taught me this in school. These are the types of conversations that you just learn by doing. So yes, the more people that reach out and ask questions, we can get rid of the stigma and just have the conversations, and we can all come together and admit that we learned by making mistakes.
Yes.
I did it too.
And I can remember, years ago, and like I said, not that many years ago, but no, it has been quite a few years ago at this point. But I remember being on a college campus. I went to school for my undergrad at URI. And I remember that one of the jobs that you could get was signing people up for credit cards and student credit cards. And years later, realizing that was actually later on banned because of, that was like, oh, hey, look I've got this cool like backpack. If you sign up for a credit card, obviously at an astronomical rate. And it was like, oh, this is one of your friends actually selling this to you. This is great. And like, I'll have my own credit card and this is the first time. And then you realize like, it really was predatory to do that.
Can I tell you, it's so funny that you were sharing this story, because I like to send out a monthly newsletter. So I'm going to give a quick plug.
Okay.
And the article that I sent, which I'm going to post on my website as a blog, I titled it Confessions of a Debt-aholic. And it's my personal story about struggles with credit card debt. And that is exactly how my story started, signing up on my college campus.
Yeah. And I think, and it was, and what was the card? It could have been $250. It could have been $500. It wasn't tons and tons of money. But it was enough that it was enticing for someone that is in college, and potentially, that could definitely stretch your budget a lot more than what your parents are willing to do, or a lot more than what you're able to get on an on-campus job. And, when I think back at that, it's like, oh my gosh, I can't even believe that was the case.
So let me share this with you. There are two rules that I share with absolutely everybody when it comes to credit cards. And this is so applicable. It may have started as a $500 card, but in my case, 4 years later, when I graduated from college, I had a $12,000 credit line, because every time you make an on-time payment, they up that limit.
Balance. I was like, oh my gosh, that didn't happen to me. Okay, no, you're right.
They increased your credit limit.
Yeah, exactly.
So the two things that I share with folks is, when you open a credit card, or even if you have an existing credit card, if you have a credit line that if you were to spend every penny of it, you wouldn't be able to sleep at night. It would be a significant hardship to have to pay it all back. You can call your credit card company and tell them to lower it.
Okay.
But the other thing you can tell them to do is not to increase it without your permission. They should not be automatically increasing your credit line. You can call and request it when you need it, but don't let them do it on your own.
Okay. And it's funny that you even say that, Christina, because a lot of times I've seen, like, especially if I have like a credit card, even like a store credit card that I may have had, and now I haven't used it for a while and it's a zero balance. A lot of times I'll get an email that says, hi, do you want to add someone to the card?
Oh yeah. Yep. Yeah, because they figure if they can get somebody else to sign onto the account, then it'll get used again.
Yeah, exactly. It's like, hey, is there anyone else out there that you have? Like, do you want to add an authorized user? And that brings a really good question, because I feel like when obviously that's something that you should take very seriously. And I think a lot of times it's thrown around like, hey, is there anyone else that might want to use this card? What are the responsibilities of, like, say I give my card to even my son? Fortunately, I don't think he wants to shop at many of the places I'm shopping at in terms of my store credit cards, thankfully. But at the same time, like, what is the responsibility as far as that goes? If I add this other authorized person, are they getting a credit check? Could it potentially, how does that actually work when you do add someone to a card? And what are your actual responsibilities on that?
Definitely. When you add an authorized user to your card, they also become responsible for that account. That account will show up on their credit report. If there's any late payments, missed payments, that will show up on their credit report as well. I actually have a mother-daughter client team that I work with, and the daughter was added as an authorized user to the mom's credit card. And I forget why, whether it was to help her build credit history or if it was just something that she could have access to in college. But unfortunately, the mom ran up quite a balance. And because of the high percentage of credit utilization, it was impacting the daughter's credit score.
Okay. And is it easy to get someone off of a card?
Yes.
Okay.
Yeah, just as easily as they were added, they can be removed because you're still the owner of the account. You are still in control. So you can add and remove users as you choose. But important to note for the authorized user is that it's more intrusive on their end than they think. They're not just being allowed to take your card legally. It's going to show up on their credit report.
Okay. That makes sense. And then it would say, for some reason, if I had someone and they had like a amazing credit score, and mine sort of average, will that then allow for the potential to bring up the limit? Is there any advantages there, or that it's really sort of, it's your card, it was under your name, even though they're responsible, they're not necessarily taking their credit into consideration to that extent?
Right. You're the one that's still responsible for the payments. So any impact to credit score as far as that goes is going to be mainly on you. And as I say that, I'm saying to myself, but no, if there is a missed payment, it's going to impact the authorized user. Because where my mind is going with this is credit cards are impactful on your credit score in two ways. One, you got to make your payments on time. But two, they measure how much of that available credit you're actually using. And the sweet spot is to keep it below 30%. So if you have a $10,000 credit line, as long as your balance stays below $3,000, it's not going to significantly impact your credit score.
Okay.
But let's say that balance creeps up to 5,000 or 7,000. Now you're using 50 or 70% of your available credit. That's when your outstanding balance starts to have negative impacts on your credit score. And that will happen for both the owner of the account and the authorized user.
Okay. Even if you are paying on time, that doesn't matter. It's the amount of credit that you're using at any given time. So with that being said, I know personally there's been times where it's like, whoa, like you've had, I believe me, I've been through it in terms of trying to restore credit. And like we said, that horrible on-campus experience in terms of credit card signups, which definitely I'm so thankful that some people don't have to deal with that now, being on a college campus, and that has not been allowed and is illegal. But the thing that I was going to say is, like, in terms of trying to get your credit utilization down, is it better to try to do that across the board with cards, or should you really, if you have to focus in and hone in, should you try to bring it down like one card at a time? So like if I have $500, is it easier for me to hit one card, or is it better for me to do 100, 100, 100, 100, 100 across the board? Like, what would you say might have the greatest impact to your credit, and probably even the quickest way of getting it down?
Yeah, so my thought is to attack it either one of two ways. If you're a person that needs some immediate gratification and you really want to get some things paid off, what I guide clients through is setting up sort of a snowball effect. And I think that's a Dave Ramsey term, but either way, what you do is you just gather all of your accounts, you figure out how much within your budget you're allowed to dedicate to credit card payments each month. You take that lump sum and you divide it among all the accounts. You pay all the minimum payments, and whatever you have left over of what you have in your budget to pay, you lump it all onto one card. And you can choose. You can either aim for the card that has the higher interest rate, because that's the card that's costing you the most. Or you can aim for the one with the smallest balance, because that means if you're aggressively paying toward it, that's the one that's going to go away first. As far as its impact on your credit score is calculated using two different factors. It's going to look at the overall available credit you have among all of your cards versus how much is outstanding. So you get a credit utilization percentage that way. But each at the individual card level, if there are some being overutilized, that's still going to have an impact.
Okay. Okay, that's really good to know because I didn't know if it was more as a whole or individually. So it's good to know that
It's
it's sort
actually
of
both.
it's actually both. Okay. Yeah, they get you both ways, but at least if you're sort of chipping away, that actually does help. So, and would you say, someone that potentially, struggled in the past, is there would you recommend a specific credit card, how to start out? I've heard of unsecured and secured credit cards. Can you sort of talk about the difference, or what would be the best way to either hopefully maybe repairing some credit if you haven't had a card in a while, or potentially even starting some credit, which beginning some credit history where, people may not have had that yet.
Right. So funny enough, I've heard this from several colleagues in my field and also people that work in the mortgage lending industry. Having no credit is actually worse than having bad credit.
Yeah.
So,
Yeah. Like
you definitely want to establish a little bit of credit history. It's craziness. Credit scores are just the strangest, most illogical thing in the world because you do get rewarded for using those credit accounts and paying them back on time and using them and managing them appropriately, right? Talking about that credit card utilization. So as far as the types of cards that are good to start with, a secured credit card is really meant for folks that are repairing credit, people that are coming off of bankruptcy. And secured credit cards, unless you're in those extreme circumstances, a bank generally won't approve you for the secured card. All the secured card is it's usually a very small limit, $200 or $300. And you as the account holder have to deposit that $200 or $300 in the bank. The bank will hold it as collateral while you use that credit card. So they have your savings. You're going to use the credit card as you normally would. You're going to use the card. You're going to pay the bill every month. But if it ever gets to a point that you can't pay that bill, the security is in that savings account. The bank knows that there is cash there to pay off that line, right? So again, great for people that are repairing some significant credit problems.
Okay.
Usually it takes a year or less when you use a secured credit card responsibly to be able to convert it to a traditional credit card and get that savings deposit back.
Okay.
As far as what types of cards to start with beyond that, it depends on what you want the card for. If you just want it for, emergencies or just something to help build credit history, make sure it doesn't have any annual fees. All credit cards are variable interest rates nowadays, which means it's going to change with the times as the Federal Reserve changes the interest rates. Everything's double digits. With as cheap as it is to borrow money right now, credit cards are still across the board above 12%, even for the best, highest rated credit scores in the country.
Great. That's definitely very helpful because once again, it's like, at this point, like if you have credit, if you're trying to rebuild credit, or like you said, I mean, even trying to get rid of, trying to potentially lessen the credit utilization that you have, it's always great to know what options you have available. Now, would you say, Christina, that it's better to get a card to zero and keep it open?
Yes.
Or would you is there any scenarios where it's like, it looks like on your credit report, you have a lot of accounts that's working against you? When is it good to actually close an account?
It's a very emphatic yes to keep those accounts open.
Okay.
Because another factor that's used to calculate your credit score is the age of your credit lines. They're looking for you to have mature credit lines. So you've demonstrated longevity, and over that longevity, have you demonstrated responsible credit usage? So if you pay a card down to zero, great job, but do not close it. Leave it there.
Do not close it. And would there ever be a scenario where you don't use it for a long time that it will get closed by the lender?
It could happen. I see it happen more frequently with the store cards, though, than you do with the major credit cards.
Okay. So usually, so maybe, and I don't know if that ever comes with any warning, but I'm just sort of wondering, sometimes it might be good to put $20 on it and pay it right
Yeah.
back off. It doesn't need to be anything that's really, huge, that you're,
Exactly.
all of a sudden you have to go on a huge shopping spree and you're back in the same situation again. But even just to, keep it going just a little bit. But yeah, that sounds really
Exactly.
great. Oh, definitely. Thank you. So one other question that I have, is what would you recommend at this point in terms of, the housing market? So I know you touched on that a little bit. Like, do you think, in the year ahead, are we going to see the market stabilize a little bit? I know right now it looks like it's a seller's market,
Mm.
versus a buyer's market. Is any of that going to shift? What would you recommend right now in terms of buying and selling, and especially versus rent? And I have to say, rents are not cheap. I mean, I think
Oh.
before, sometimes the rent could be just as much or even more than a mortgage. So how do people sort of balance those things out and take everything under consideration?
Yeah. So it is more advantageous to spend your money on your own home than it is to spend it on rent, because you're absolutely right. And rent has been about the same cost as a mortgage for the last 10 years. It
Okay.
has really made a lot of sense. If you have the ability to buy a house instead of paying rent, you're probably going to be able to get into a house for the same amount that you're paying in rent.
Okay.
So it's always worth considering if you have the ability to do that. Um, if you have the opportunity to sell a piece of property right now without having to buy something else, it is a wonderful time to do that.
Okay. Great.
um, it's people that are buying homes right now that are definitely paying more than they would have a few years ago. But there's some relief to that because interest rates on mortgages are so low.
Okay.
So with that said, I don't see home prices changing a significant amount because we know interest rates are going to stay low for a while. Our Federal Reserve chairman has already come out to say he's willing to keep interest rates low for an extended period of time, even if inflation creeps up, because the
Okay.
economy is just that fragile. So I think home prices are going to stay where they are. I don't think they're going to skyrocket much more than they are now, because we're in sort of a status quo at the moment. We don't know what the future holds as far as the pandemic goes. We don't know what future economic stimulus we're going to see. We don't know what's going to happen with evictions and foreclosures once all these moratoriums wear off.
Yes.
Foreclosures could be one thing to drive prices down. If there just happens to be a flood of inventory to the market, it could drive prices down a bit, not a lot, because there has been a huge inventory shortage in real estate, again, for better than 5 years. There's just not enough sellers for the number of buyers that are out there. That's been a problem even before 2020.
Okay. Yes.
So,
Okay.
yeah, there's a lot to consider
Yeah,
there.
it definitely is. And I think, again, like, all your information is really helpful because, a lot of times I know as a renter, people are like, well, why don't you own something? And I'm like, I'm not ready yet at this point. And I think part of that too is like where I am right now in school and my career. And sometimes it really needs to be the right time under the right circumstances. But again, like right now, do you feel like there's a lot offered for, say, first time home buyers or different incentives as far as that goes that you're aware of?
There are still a lot of great programs for first-time home buyers. There's down payment assistance programs available. FHA, which was a program we mentioned earlier, is really great for first-time home buyers. It helps them give a nice low down payment. Um, the trouble that first-time home buyers are having right now is generally what creates the cash on hand for a down payment for a house is when you sell a previous house.
Okay.
I did this, and I know a lot of first-time home buyers do this. That very first property that you buy, you take advantage of low down payment programs or down payment assistance programs just to get into it. And then you live in it for a few years, you pay down the mortgage, the property values increase, and when you go to sell it, now you have cash to pay forward to your next home.
Yes.
The problem in this market is because there's so many buyers and not enough sellers, there's two things that are pushing first-time home buyers out of the market.
Okay.
One, the speed with which homes are being purchased is really challenging. A realtor could put a house on the market at 10 a.m. and have a signed purchase and sales agreement by 4 o'clock that afternoon. It is just moving so rapidly. And what's happening is that the sellers are being provided more information about their buyers these days. They are being told whether or not that person has cash to put down, or if they are going for an FHA program, or if they are, if they're married, if they're single, if they have kids. Gosh, my husband and I sold a house 3 years ago almost, and we got a letter with the offer saying, here's my name, here's what I do for a living. I have a girlfriend that I want to ask to marry, and we're going to raise a family, and we love the swing set. So these buyers are having to state their case beyond just their offer letter to get these homes. It's really interesting. The other thing that's pushing first-time home buyers out of the market is anybody that has cash on hand. If you are someone that has cash that you've been saving and you've got a 20% down payment, the seller is going to be more enticed to go with you because there's less of a chance of a hiccup in the mortgage approval process.
I get what you're saying, because I was actually going to ask you, like, why would that even matter in terms of the actual seller? But I can see what you're saying. Like, they want a smooth process, and they want to know that if they're potentially trying to get out to get another property, they want things to move smoothly as well. So that makes perfect sense as far as that goes.
Yeah. So what I'd say as far as real estate goes is please have a good financial planner so that you're looking in the right price point. Okay. Mm-hmm. You need a good mortgage lender that's going to communicate with you, and you need a good real estate attorney. Do not use a title company. Get your own attorney and interview the attorneys that are available to you. Every bank has a list of attorneys that they are allowed to work with for these real estate closings. You do have the right to choose which attorney you work with. And I highly encourage you, even if you just tell your lender, give me 3 names, I want to interview them, you have the right to do that because you need somebody that's going to be communicative.
And so can you just explain, Christina, for the people that you just mentioned that you need sort of on your team, what are each of those, what is their role in terms of how they should be helping you?
Definitely. So the financial planner is absolutely your main support system. That's the person that's going to be most accessible to you. They are going to have the most intimate knowledge about your financial situation to be able to give you an honest and unbiased opinion about what they think you can afford.
Okay, that's great.
Your mortgage lender, this is the person who's going to take your loan application, gather all of your financial information. They're going to ask you for things like your 2 years tax returns, 2 months bank statements, your latest pay stub, and then any questions that result from the review of those documents.
Okay.
They gather that package and hand it to an underwriter. You will never be allowed to speak to the underwriter. The mortgage person is like the face of the operation, and all the questions that the underwriter has are going to flow through the lender, the person that took the initial application. So they are the person that should be keeping you informed of, here's where we are in the process. Here are a few more documents we want to take a look at, and just keeping you up to date on that timeline. The mortgage lender also very frequently communicates with your realtor because the realtor needs to know where you are in that timeline for all of the agreements that are involved with the purchase of the home itself. Because there are there's a certain timeline to be agreed to when you sign that purchase and sales agreement. When you sign that purchase and sales agreement, which your realtor is responsible for explaining to you so you know what you are agreeing to, you have to give a deposit and you have to say, I will have a mortgage approved, ready to close, traditionally within 45 to 60 days.
Okay.
If for any reason there's a problem with your mortgage and you may exceed that time limit, your mortgage lender needs to communicate that to you and your realtor, and your realtor needs to take action to speak with the seller to say, we need to sign an addendum. We need to extend this mortgage contingency. So all of these people have to work together to make sure you stay within the confines of your contract and you agree to, or you live up to your end of the bargain.
Okay. And so what would the lawyer then be involved in? So you're saying like interviewing the lawyer.
I knew I was forgetting something. Thank you for reminding me. The lawyer. The lawyer does a lot of behind the scenes work.
Okay.
Where the lawyer is helpful to the buyer, number one, as much as your realtor wants you to sign a purchase and sales agreement, like instantaneously, as soon as that offer is accepted, they have a purchase and sales agreement in your email box. Just sign it and move on. Have a lawyer look at it first. Don't ever, ever, ever sign a document you don't fully understand. If you can't read it on your own and understand it, get a lawyer to explain it to you. Because you could be agreeing to certain contingencies within that purchase and sales agreement, not knowing what they mean. Okay. So that lawyer needs to review everything before you sign it. And then behind the scenes, the lawyer is doing their title research, making sure there's no other existing liens or claims to the property, making sure you have a title insurance policy for your own purchase so that if for some reason they missed something in their research, you have a title insurance policy to say, okay, well, I'm covered. I'm not going to be personally responsible for this because that was their job. That's my insurance policy. And then in the end of it, the attorney is responsible for producing and having you sign all of the documents that you're going to sign either to sell your property or to buy the property and to agree to your mortgage contract. So again, this is where the attorney steps in to say, I need to explain to you all of these documents that I'm going to ask you to sign right now.
Okay. And then just so you would obviously need to also plan on having the money on hand to pay all those individuals, or does some of that come from somewhere else? Is that like, that might be a sort of a crazy question, but where does that come from?
That is a good question. That is a very good question. When you purchase a home, let's say you're buying a $200,000 house and you want to put down $10,000. That's great. So you're going to finance $190,000, but you still have to pay the mortgage company, the attorney, the realtor commissions. There's a lot of what they call closing costs that are involved in that transaction. If you don't have cash on hand to pay for those, which even people who do have cash on hand to pay for those generally don't, because interest rates on your mortgage are so cheap, you can actually borrow that money. You wrap it into your mortgage. So if you have $8,000 worth of closing costs, you're buying a $200,000 property, you're going to put a $10,000 down payment, but then you're going to add back $8,000 in closing costs. You're going to finance $198,000.
Okay, that's great to know. So the lawyer can potentially, on those other people, can be included on that. Like it's actual closing costs. So it's not to say you have to save an extra $8,000 to be like, oh my gosh, what do I owe you?
No, not at all.
Definitely. So another topic that I sort of want to move to as well, and you've been so great at answering all these things, and I have to say I'm learning so much, so I definitely appreciate it, and I really hope that the people listening to this podcast will certainly, I can't imagine, won't learn a lot from you as well. So another thing would be in terms of, tax season is around the corner, as we know, and again, people being strapped for cash, this could be one of the main ways they were like, hurry up, I want my income tax return back. So with that being said, again, we do see a lot of advertisements, and I'm sure more will be, more will be coming up in the next couple weeks with everyone getting their tax statements and everything in terms of being able to file. With that being said, do you ever recommend anybody taking one of the refund advances that they talk about? Or is there a better way to maybe even getting your income tax, any refunds that you might be able to get sooner than later, especially if you're in need of them?
Yeah, if you're definitely in need of that tax refund now for some urgent cash needs, from the research that I did in looking at different major tax preparers, they are offering these tax refund advances with no fees attached, which is helpful. But sort of the fine print to dig into so you understand exactly what that program is, it's a loan program. So what they're going to do is they're going to ask you to bring your W-2 if you have it. They're going to do up your income taxes. The window where the IRS begins accepting tax returns has not opened yet. We expect them to open it anywhere after the 15th, but definitely by February 1st.
Okay.
So what these companies are offering is, okay, based on our preparation of your taxes, we think you're going to receive X dollars in a refund.
Okay.
We're going to run your credit and we're going to see if we can approve you for a percentage of that. So if you're expecting a $2,000 refund, they may give you an advance of $800. They're not going to give you the full dollar for dollar.
Okay.
But they are going to run your credit because it is a loan program. Let's assume you get approved. That's great. They're going to put $800 on some sort of debit or Visa card for you so you can go shopping right away.
Okay.
When your refund is officially filed and accepted by the IRS and your refund comes in, it's built into their system that the tax preparer will take the advance that they gave you and deposit the rest to you. So you actually don't have to go through any extra steps to repay that loan, which is helpful.
Okay.
The only thing to be mindful of is one of the programs I noticed, they said they use the Visa Green Dot program. So if you're going to take advantage of this, just know whether or not there are going to be any fees associated with that card. It may be that, let's say, H&R Block isn't going to assess any fees for giving you the advance, but the debit card that they put it on may assess a monthly maintenance charge or something to that effect. So you want to be aware of that.
Because that could be another way that you're potentially paying, but it's not assessed necessarily by the actual place that you might be going, the tax preparer. No, that's definitely very helpful. And again, I mean, it's nice to see that that might be another option for someone, especially right now. And actually a very good option.
You made me think of something else that I wanted to share. There were a lot of people collecting unemployment last year, getting that extra $600 a week.
Yes.
For anybody that was receiving any subsidies for their health insurance, maybe health insurance that they bought through the marketplace through HealthSource RI.
Yes.
One of the things to be mindful of, unfortunately, is that that extra $600 a week does count toward your income, which might, though the way the subsidies work for HealthSource RI is that at the beginning of the year, they ask you, what do you expect to earn for income?
Okay.
In this case, in 2020, what do you expect to earn for income in 2020? Based on that estimate, they offer you a corresponding subsidy. If at the end of 2020, it turns out that you earned more than what you estimated, which for people that were earning that extra unemployment may be in that situation, they can go back and reclaim some of the subsidies that you were offered.
Okay.
Which means you'd have to pay back some of what you now are no longer eligible for based on what they see as your level of income. So people who might be expecting a refund may be unpleasantly surprised by the fact that they're going to out of their refund is going to be claimed a repayment of some of those healthcare subsidies.
Okay, because if they ended up getting more money than what they stated because they weren't anticipating the extra 600 or potentially 300, that could be an issue. So say, what would you recommend then, say in 2021 to potentially, I mean, I don't know if the enrollment probably already happened, but is it better in the future if you're ever in that situation to aim high, aim low, or really just try to ballpark it the best you can of what you've been making?
Yeah, ballpark it the best you can. That's all you can do. Who would have ever anticipated going through what we went through in 2020? You know, there was no way.
Yeah.
Now, having said all of that, though, with a new administration coming in, that type of repercussion of having the extra unemployment, our government can change it. Congress can come out and say, you know what, we're not going to have anybody repay the subsidies. We just need them to take action on something like that. Because when the window for filing opens and people start to see that their refunds are reduced because of these subsidy repayments, there's going to be a lot of opinions about that. Okay,
definitely. And so the topic that I sort of want to end with is student loans. There's been a lot of talk with our president, our new president that's going to be coming in, President Biden, and he's talked a lot about student loans and potentially providing some level of forgiveness on the student loans. So one thing that I always think of in terms of student loans, again, I mean, most people, I think most ordinary people usually are taking student loans, borrowing for their education. When do you recommend that the student specifically borrows for student loans, or the parent is taking student loans on behalf of the student? Because again, I think, when parents, they're obviously, a little bit older, it doesn't depend on if they're closer to retirement, there could be different implications. And especially, I don't know if any of these programs are really going to consider any parent loans. So what would be your recommendation surrounding student loans, and especially in the upcoming, potentially the upcoming year?
Generally, I encourage the student to take on the loans, and here's why. The parent can always opt to help the student repay the loans rather than putting themselves on the hook for it. There's one major difference between a student loan and a parent loan. A student loan is able to be deferred. While the student is still in college, they're not required to make payments. A parent loan goes into repayment immediately.
Okay. Yes.
So if you're looking for that flexibility, then by all means, let the student take on the loan, let them defer it. You can make payments during a deferment. So another thing to consider, sort of a strategy, is let the student take on the loan, let the loan be deferred, but the parent can begin making payments right away if they choose to. But then if something happens or if they choose to, they can stop also.
Yes.
Give me a second. I had another thought about that. Oh, I lost it, but that's okay. If I think of it, I'll throw it out there.
I know, I'm throwing
but yeah, that's the
it
biggest
out.
distinction for me.
Okay. Yeah. And I mean, so I think the thing too is it's like, again, like, and typically, like you're saying too, it doesn't seem like a lot of parent loans might be able to potentially, get any kind of forgiveness. So is there a potential for
That's
parent
right.
loans to get forbearance or deferment? Do you know at this point?
Yeah. So if a parent were to request a parent plus loan be deferred or go into forbearance, you're facing a similar circumstance like we were describing earlier,
Yes.
where you could still end up with late payments on your credit report. It could be tacked onto the end of the loan. There are some credit ramifications for that. Whereas the student who is borrowing and in school and deferring those loans, there's no ramifications to that. It's part of the program.
Okay.
What I wanted to comment on, you mentioned the political environment as it relates to student loans. And, even before President Biden won the election, I was speaking with clients about, this whole topic of student loans throughout this pandemic. It's always been sort of a simmering topic, but over the course of 2020 on the campaign trail, and as a result of this pandemic, it has become higher up on the list of priorities of things that need to be addressed.
Yes.
So there is definitely a potential to see some relief for student loans, but as you suspected, and I agree with you, it would more than likely be geared toward the students that own the student loans and not the parents with the plus loans.
Okay, that makes sense. And I guess the other thing too is like related to student loans, and I mean potential. It would be wonderful to see some potential forgiveness. I just had a thing that I was thinking of and completely lost. Oh, impacts on credit history. So what I was wondering too is like, or impacts on credit overall. When we think of student loans, and this could be completely something that's not true, but as long as you're current with your student loans, is it considered as like a bad debt to have? Does it work against you? Because I've heard of things like a good debt, a bad debt. I don't know if there's any such thing as a good debt or bad debt,
Yes.
but again, like say like you're considering, getting a loan or potentially making a bigger investment, as long as your student loans are current or potentially in deferred and in good status because you're going to school, is that looked on poorly that you may have higher student loans or a higher amount of student loans? I know for myself, I'm in the process of getting my fourth degree. So I have a student loan debt that's very similar to the national debt right now.
I know, right?
But no, I mean, realistically, I mean, again, I mean, just thinking of different things, and just wondering, like, how does that affect you overall in terms of potentially being a homeowner in the future, or even overall affecting your credit?
Yeah. So there's two things I'll say, and I'm going to say both of them now because if I forget one of them, you have to remind me.
Okay.
So we're going to talk about debt to income ratio, and I've already forgotten the other one. What was the first thing you asked me? So let me talk about debt to income ratio, and then you can go back and say the question again, and I will remember. See, short-term memory loss. It's getting late.
Yeah.
Debt to income. So, good debt versus bad debt. It came to me. We're going to talk about debt to income ratio and good debt versus bad debt, because that is definitely a thing. Okay.
Oh, okay. Well, I'm happy I didn't just like make that up in my head.
No.
This is but again, I mean, I think sometimes you're having to make some tough choices, right? So once again, no.
So as far as having student loan debt on your credit report, if it's in good standing, it's great, it's helpful. If you are applying for another type of loan, let's say you're applying for a mortgage or applying for a car loan, there's something that's referred to as a debt to income ratio that's going to be examined. And what they're looking at is how much debt do you have outstanding versus how much income you're earning. And if that ratio is higher on the debt side than on the income side, it's possible that you may not be approved for that mortgage. And I'll tell you what, I say mortgage very specifically because student loan debt is highly impactful to your ability to be approved for a mortgage because of its impact on your debt to income ratio.
Oh, okay. So not because it doesn't have to do with like, oh, I paid it, well, I'm in good standing or whatever. It's like, well, unfortunately, you have a lot of debt.
Your score may look spectacular.
Okay.
If that debt to income ratio is higher than where the underwriter, where their guidelines need it to be, then that's going to be a roadblock.
Okay. And are there any ways of going around that? I mean, I think past a certain point, you borrowed what you borrowed. I mean, is there a way to sort of consolidate that or do something differently with that? Is there anything else that you could potentially do?
Consolidation doesn't change the outstanding balance. It
Okay.
may lump everything into one neat package for you. It may lower your interest rate overall, but it's not going to change the principal balance. So yeah, you kind of said it right. You borrowed what you borrowed. You just got to start paying it down. You either have to pay down your debt or increase your income to change that ratio.
And I was going to say, neither seems very easy at times, but
no.
hopefully if we'd like to say, like, hopefully if you did invest, in your education, then hopefully it will lead you to, a better job and more opportunities. So hopefully that will, be something to consider. But no, thank you so, so much. I mean, I think you've certainly given us a lot of food for thought, especially in 2021, figuring out what's new, what might be much of the same, and then also, covering so many different topics. And I'm sure we'll potentially think of many more. So, Christina, based on your services and the services of your company, are you looking to get, I know your company's called Me Next Year. So I want to know, like, are you taking on clients at this point? What is your specialty in working with people? How does that work? Because I know I've known you for many years and see you as such a trusted resource, and your expertise is obviously, it's wonderful and so helpful. So just want to know, like, what options do people have potentially to reach out to you in the future?
Yeah, definitely. I am actively taking on new clients.
Okay.
You can find me at menextyear.com or on my Facebook page, Christina Gatteri, CFP. I named my company Me Next Year because there is always a me next year waiting to be discovered. Life changes so rapidly, even without a pandemic.
Yeah.
Life changes very rapidly, and to have things in order so that you can adapt to those changes without high levels of stress is really what I aim to help my clients do. I love working with young families. I love that 35 to like 45 or 50 age bracket, because within those ages, there's a lot you're dealing with at one time. Maybe we're dealing with some of the things we racked up in our 20s, like student loans and credit cards, right?
Yeah.
But maybe now we've got children, or we're developing our career, we're going back to school, we're getting married, we're buying homes, we're buying cars, like all of these things are happening.
Yes.
And at the same time, we still have to be mindful of our responsibilities to ourselves for the future. So there's a lot on us at one time, over and above just the normal day-to-day stresses that we deal with.
It's like past, present, and future. Like, so definitely, it's like, what did I do in the past? What do I not want to do again? And how do I repair that? What do I do in terms of meeting the demands in the moment? And then in the future, how do I actually live the way I want to live, and hopefully cross your fingers that this all pays off. So
exactly.
And that definitely.
So right now I am working purely virtually, so I'm really great at the Zoom calls and the telephone. But yeah, I love, like I said earlier, I'm very passionate about mental health and understanding people's lifestyles. Please visit menextyear.com. I've got a great blog page where I share more about my philosophy and the way I work with clients. So it's a great place to start.
Thank you. And then can you even just mention just maybe a couple, like 3 of your top things that you work with clients? Because I think, again, people think like, oh, let me come with my portfolio. And it could be someone that's really starting out. So I'm sure it's probably a diversity of different clients, but can you sort of give us a little bit of an idea of that?
Definitely. So step number 1, we have to understand your cash flow. What's coming in? Where is it going? What kind of debts are you dealing with? We want to make sure everything is healthy. What's your good debt and what's your bad debt? What's the difference between all of that? So many people get wrapped up in their day-to-day lives that they don't sit down and really assess where they are right now. So I like to get that baseline. And then, of course, develop strategies to make sure whatever income you are earning is being utilized to the best of its potential. I do work with investment portfolios, but that doesn't just mean that you have to have money to invest. There are plenty of people contributing to 401ks through their employer that have never looked at the investment options available. So I offer those services as well. I can take a look at what your program is, whether it be 401k or some other variation of a retirement plan. Make sure you understand it, make sure it's invested properly, and make sure you're paying attention to contributing to it. So that's sort of the investment portion. I also help clients select their health benefits when we go through open enrollment, whether it's through the marketplace or through your employer. You got to understand what you're being asked to do, and I can help walk you through that. And there's many other things that I can help with. So again, on my website and on my Facebook page, I've got some really great service tabs to take a look at for you to sort of get some bullet points about what those things are. But yeah, just those basic day-to-day financial stresses that always end up at the bottom of your to-do list. I'm the person that's going to help organize it and make it digestible so that you don't feel so overwhelmed every time you want to look at it.
And I'm sure you're really great too at just like making sure there's like no shame. It's like it's an open conversation, it's a private conversation, and it's just basically just helping people optimize where they're at, assess where they're at, optimize who they want to be, and and hopefully come up with some real strategies that you're working with people. You're not telling them what to do. It's like, and again, I think so many of us, I think all of us needed you. So definitely, I'm so happy to have you on Meet Up with MeLa. I know that it's definitely so much information, and I hope that we can touch base with you again in the future. This has been so valuable to me personally, and I hope for our viewers as well. So thank you so much, Christina. Again, this is Christina Gatteri, a certified financial planner, and please reach out to her on Me Next Year is her company. And again, stay tuned for Meet Up with MeLa podcast, where the conversations affect us all. Thanks again, guys, and hope to see you soon. Bye-bye.